September 9th, 2025, a bank in Cincinnati quietly writes off a $200 million loan and uses the one word no lender ever wants to say out loud: fraud. 24 hours later, a Texas car lender called Tricolor is dead. 18 days after that, a car parts company carrying more than $10 billion of debt goes down too. Then, Jamie Dimon, the most powerful banker in America, says 8 words that wipe billions off an entire industry. When you see one cockroach, there are probably more. Here's the strange part. A few weeks later, he took half of it back, and almost nobody heard that second statement. By the end of this video, you'll know why. And you'll have a simple 3-number test that tells you whether any financial panic is a real 2008 in the making or just somebody's content strategy. Because right now, some finance channels on this platform are telling you that something called private credit is about to blow up the world economy, Lehman Brothers style. The market is real, the stress is real, the frauds are very real, but the 2008 comparison, that's where things get interesting. Stay with me, because the truth is stranger than the thumbnail. Start with what actually happened, because the real story is juicy enough without any help. Tricolor Holdings sold used cars in Texas to people with bad credit and lent them the money to buy those cars. In September 2025, prosecutors say the truth came out. The company had been faking the value of the loans backing its debts since at least 2018 and promising the same loans to several lenders at once. Fifth Third Bank discovered it was holding a $200 million piece of that. Tricolor Holdings shut down. Gone. First Brands was bigger. A car parts empire built by buying up other companies running on debts hidden off its official books. Debts that, let's be polite, were barely explained to the people funding them. In August 2025, a $6 billion deal to refinance its debt fell apart because lenders couldn't get straight answers about its earnings. By September 28th, it was bankrupt, and its creditors discovered that here too the same collateral had allegedly been promised to more than one lender. 2 collapses. Same month. Both frauds. And both were funded not mainly by banks, but by a lending industry most people had never even heard of. Then came the cockroach quote on JP Morgan's October earnings call. Markets did what markets do. Investors started asking for their money back. And this is where it turned into content. In the first quarter of 2026, the gates started closing. Blue Owl, a firm that grew from about $50 billion under management in 2021 to roughly $300 billion, capped withdrawals from its retail credit funds after $5.4 billion of exit requests landed in a single quarter, with another $4.7 billion right behind them in the spring. Apollo, Ares, Morgan Stanley, BlackRock funds, all limited withdrawals too. Blackstone tried to be the hero. When exit requests hit its flagship BCred fund, that's nearly 8% of the whole fund in one quarter. It paid every single dollar, helped by a $400 million rescue package that included $150 million of its own executives' personal money. Then, second quarter requests hit 10%. And in June, even Blackstone put the gate up. By this July, Bloomberg counted $14 billion of investor money stuck behind those gates. And look, if your savings are on the other side of a locked door, nobody needs to explain to you why that feels like 2008. The word gate alone does the emotional work. But here's the thing. Those caps, usually 5% of the fund per quarter, were written into the contracts on day one. They exist precisely so that a panic can't force the fund to sell its loans at fire sale prices. The gates going up isn't the system breaking, it's the system doing the one thing it was designed to do at the worst possible moment for its own reputation. Now, a freeze frame, because everything I just told you is true, and it's also exactly the moment the scare machine switched on. To understand who's panicking and why, you need to know what this thing actually is, and I promise this is the least boring explanation of private credit you'll hear this year. Private credit is just loans. That's it. Loans to businesses, usually mid-sized companies, too big for a small business loan, too small or too risky to borrow on the bond market. But the loan doesn't come from a bank. It comes from an investment fund. The fund collects money from pension funds, insurance companies, university funds, and rich individuals. Then it lends that money out at 10, 11, 12%, and everyone collects the interest. How big is it? Honestly, like nobody agrees, and that detail matters. Around $1.8 trillion in the US, something like $3 trillion worldwide. If you count everything, The Economist Wall Street editor put it beautifully: ask two people in private markets what private credit is, and you'll get three opinions. Remember that. A market that can't agree on its own size is a market you should never let anyone describe to you with total confidence in either direction. Now, for my favorite part of this story, where did this industry come from? 2008. It was born from the last crisis. After Lehman fell, regulators forced banks to hold more capital and take less risk. Lending to mid-sized companies became expensive for banks, so they pulled back, and investment funds walked straight into the gap. Same borrowers, often literally the same people. Like, there's a famous story about a private credit conference around 2015 where someone looked around the room and realized every lender there used to work at a bank like Lloyd's, HSBC, or RBS. The risk didn't disappear. It changed its business card. Regulators gave it a long, boring official name. Its old name was shadow banking. And this industry's quietest advantage is the one nobody puts in the brochure. These loans never trade, so their prices almost never get updated. When public markets crash 20%, a private credit fund can just not change the number. Insurers and pensions love that, not because the losses aren't there, but because nobody has to talk about them yet. Hold that thought, it's going to matter. So we have a dark, lightly regulated $3 trillion lending machine born from 2008, hit by two frauds, and a wave of locked exits. You can see why the thumbnails write themselves, and every scare video leans on one number. Fitch ratings: U.S. private credit defaults hit 9.2% in 2025, the highest ever recorded, up from 8.1% the year before. That number is real. I'm not going to tell you it's fake. I'm going to do something more fun. I'm going to show you what's inside it. Fitch's number comes from a group of just 302 companies that Fitch watches in a market with thousands of borrowers. Inside that group, 38 defaults from 28 companies. And here's the detail most people miss. What counts as a default in that number includes something called a distressed exchange. That's when a company goes to its lender and says, "We can't make this payment schedule." And the lender says, "Fine, we'll give you more time, change the terms, keep going." No bankruptcy. Often, not even a missed payment. By Moody's estimate, roughly 65% of 2025's private credit defaults were exactly that kind of negotiated deal. Meanwhile, the cleaner measure, actual missed payments tracked across hundreds of these loans by the law firm Proskauer, sat around 2.5% at the end of 2025. Rising, yes. From 1.76 to 2.46 in 3 quarters, that's a credit cycle turning. It deserves attention. As a comparison, this index reached 8.1% during the COVID-19 pandemic. But do you know what 2008 subprime looked like? 30% of loans defaulting. Real defaults. Families mailing the house keys back to the bank. And when lenders seized those houses, they got back about 25 cents for every dollar they had lent. Private credit lenders today recover around 65 cents because these loans come with strict conditions written in, and one single lender who can step in early, instead of 200 bondholders fighting in court. Same word, default. 3 completely different worlds. The scare videos didn't invent the 9.2, they just never opened the dictionary, because the dictionary doesn't get clicks. Oh. And Dimon's walk back. He clarified that Tricolor and First Brands were fraud stories, not private credit stories. Fraud is a police matter, not a business model. The Cockroach clip has been viewed millions of times. The clarification barely trended for an afternoon. Fear compounds, corrections don't. Honestly, that imbalance, not private credit, that might be the most dangerous thing in this whole story. So is it 2008 or not? Let's actually run the test instead of guessing. The Economist had a lovely comparison for this, asking if every market wobble is another 2008 is like asking someone how their day was. when last year they got hit by a train. Compared to the train, every day looks fine. It tells you nothing. So here are the three numbers that made 2008 size, leverage, and the label on the box. Number one, size against the economy. Subprime mortgages in 2006, $1.5 trillion, owes nearly 11% of US GDP. Private credit today, around 5% of GDP. Half the relative size of subprime in an economy carrying much less private debt overall than back then. 137% of GDP now versus 174 in 2009. Number two, and this is the one that decides whether a system explodes. Leverage, meaning how much borrowed money sits on top and where that money comes from. In 2008, banks held safe mortgage paper with $30 of debt for every $1 of their own, funded with money they had to borrow again every single night from other banks. When trust broke, that overnight money vanished by morning. That's what a financial heart attack looks like. Private credit funds, usually about $1 of debt per dollar of their own, and the funds sold to regular investors aren't legally allowed to go past $2. Better still, the money behind them is locked in for years by contract. Pension money can complain. It cannot run. You cannot have a bank run on money that isn't allowed to leave the building. Number three, the label on the box. This is the deep one. 2008 didn't happen because assets were risky. It happened because risky assets were labeled safe, AAA. That label is what justified the insane borrowing. Nobody thinks private credit loans are safe. It says risky right there on the tin, and the high interest rates prove everyone knows it. Markets rarely die from the risks everyone is staring at. They die from the ones hiding behind a safety label. 3 tests, 3 fails, this is not the train. And if you think that means I'm about to tell you everything's fine, not quite. Because there is a path for this mess to reach the real banking system. Let's follow the pipes. Here's the question that should actually keep you up at night. Not, is private credit the next subprime? But, if private credit gets sick, can it infect the banks? Because that's when a niche problem becomes everyone's problem. Banks hold your deposits. Banks run your payments. When banks stop lending, the whole economy catches a cold. And the pipes are real. American banks have lent somewhere between $300 and $350 billion to private credit firms and their funds. The most exposed, Wells Fargo, about $71 billion at the end of 2025. More than Bank of America and Citigroup combined. So the YouTubers pointing at this are pointing at something real. Let's take it seriously and trace how the sickness would actually travel. Pipe number 1, banks lend to the funds. If a fund's loans go bad, the fund's own investors lose money first. The bank stands first in line to get paid back, usually backed by a big pool of loans worth more than what the bank lent. For the bank to lose, the fund's investors have to be wiped out first. That's a thick cushion, as long as the collateral is honestly valued. And First Brands just showed us what happens when it isn't. Fraud eats that cushion for breakfast, which is why one small number matters. Wells Fargo's problem loans to these non-bank borrowers jumped from $24 million to $245 million in 1 year. Tiny against a $71 billion book. But that's a tenfold move in the smoke detector. Pipe number 2, forced sales crash shared markets. If gated funds ever have to dump loans for cash, the fire sale prices would force everyone holding similar debt to write their own holdings down, including banks and investors in loan bundles called CLOs. By the way, if you'd like a full video explaining CLOs or any of the machinery in this story, tell me in the comments. Now, for scale, these retail funds sell about $5 billion of loans a quarter in a loan trading market that handles $85 billion a quarter. So far, the market has absorbed it without blinking. Blue Owl's emergency asset sale actually went through at roughly full value. The danger isn't today's volumes. It's what happens if the roughly $220 billion sitting in these withdraw anytime sort of retail funds ever heads for the exit in the same quarter. Pipe number 3, the one Steve Eisman, the guy who actually predicted 2008, calls a slow brewing scandal: insurance. Private credit giants now own life insurance companies which buy their parent company's own loans. Some then move their promises to policyholders offshore, Bermuda, the Cayman Islands, where Iceman's forensic accountant Tom Gober claims Those promises are backed by far less than they owe. In one case, he says he reviewed $7 billion of obligations, sat on about $200 million of real assets. If he's right, that hole surfaces years from now. Inside products ordinary families depend on. Now, the honest scorecard. The Federal Reserve studied Pipe 1 and concluded bank exposures are meaningful, but senior and survivable. The European Central Bank ran a disaster simulation. 10% of private credit loans defaulting, 30% in software, and found banks lose barely 1% of their capital. The real damage in that simulation lands later, on insurers and pension funds, not on the banks, so the backdoor into the banks exists. But it's narrow, guarded, and for now, the banks stand at the front of the repayment line. Keep your eye on it anyway. I certainly will. Which brings us to what the real experts are worried about. Howard Marks, who has traded through 5 of these cycles, says there's no systemic problem here, but the tide is going out and we're about to find out who's been swimming naked. Iceman says a credit cycle is coming, no, a cycle, not a crisis, and his real fear isn't loans blowing up banks. It's the software problem. Around 20% of these portfolios are loans to software companies built on subscription money that AI is now attacking, with no factories or buildings to seize if things go wrong. And it's that insurance chain. Slow problems, buried problems, problems that can take years to explode. Even the regulators in the US, Europe, and at the IMF keep writing the same sentence in different accents. Real weaknesses, limited direct danger to the system, never tested by a real recession at this size. Want to see why slow is the right word? Follow $1 of loss down the chain. A software company somewhere starts losing customers to an AI tool. Months later, its lender finally lowers the loan's value on paper. Remember, nobody has to update these prices quickly. A quarter after that, a pension fund reports slightly disappointing returns. A year later, a retail investor notices their fund's payout got trimmed, tries to pull their money out, and meets the gate. Every station on that line takes the hit months apart. That's why there's no single crash day for the cameras. The loss is real. It just never shows up in one place at one time, the way Lehman did on a Monday morning in September. So here's my honest verdict. Private credit isn't a car crash. It's a slow, flat tire. The realistic bad scenario is years of quiet write-downs, loans endlessly extended to avoid admitting failure, zombie companies, slightly poorer pensions. Pain that's real but spread thin, arriving at each victim months apart. In some ways, that's worse for you than a crash. Nobody ever gets bailed out of a slow leak because nobody can point to the day it happened. But it is not Lehman. A dirty kitchen is not a burning house. And if I'm wrong, you'll see it coming with 4 tripwires. Watch the clean default rate, the 2.5 kind, not the 9.2 kind. Keep climbing past normal cycle levels. Watch whether the fund gates reopen this year or become permanent. Watch whether banks, especially Wells Fargo, start cutting those credit lines. And watch the software loans as AI bites. 1 tripwire is a cycle. All 4 at once, then we can start making the scary videos. If you remember one line, make it this one. Crises don't come from the assets everyone calls risky. They come from the assets everyone was told were safe. Private credit is half subprime size, a tenth of its leverage, funded by money that can't run, and wearing a warning label instead of a AAA sticker. That's not 2008. That's an expensive, dark, overdue credit cycle sold to you as an apocalypse by an attention economy that gets paid for your fear, whether the crash ever comes or not. If some part of this still feels unclear, CLOs, those overnight loans between banks, leverage, drop your question in the comments, and I'll turn the best ones into full videos. And if you enjoy understanding the money machine, you should watch this video.